We've all had a little time to look through the budget documents, the budget for 2018 presented by the Finance Minister. Do the math numbers add up? Does the fiscal scenario play out as markets had anticipated? And what is the outlook for the economy now that we have this budget in place? Hoping to get some answers from Sajjid Chinoy of JP Morgan, who is joining us for this conversation. Sajjid, thanks so much for taking the time to speak to us. Sajjid, just want to start with the fiscal math. Does the fiscal math add up to you, both for FY18 and FY19? Couple of small items, like for FY18, the DEA secretary told us they've still accounted for 44,000 crore in dividend from the RBI. For next fiscal, the subsidy numbers for one look a little bit, optimistic. What does the math look like to you?
Hi, Ruth. Good evening. I think, firstly, just to step back for 30 seconds, and, this was, I think the government kind of walked a middle path. Rarely can I remember a budget where there were so many pulls and pressures and so many constraints. So I think to limit the slippage to 0.3% is not such a bad outcome, especially given the fact that the government didn't have access to the 12th month of GST revenues. Now, as you pointed out, there still are some uncertainties here. I think for FY18, apart from the RBI dividends, even some of the indirect taxes related to GST would need to grow quite strongly over the next 2 or 3 months. But, I think having printed this number of 3.5%, I think the government will do what it has to do to keep at 3.5. And therefore, if the pressure increases, I think expenditures will be cut in the month of March, because this is a cash accounting system. So I don't doubt the fact that the FY18 outcome will be at 3.5. The good news, I think, is FY19, having a smaller consolidation is much more realistic, much more tenable. Some in the market had called for 0.5% of GDP consolidation from 3.5 to 3, which would have been, very hard to achieve in a pre-election year. I'm very positively surprised by the expenditure restraint. What you see is current expenditures are growing much less than nominal GDP, and therefore they come down as a share of GDP by 0.2%. So the entire consolidation next year is on the back of current expenditures being cut, which is very admirable restraint. CapEx is maintained at the same level. If there is one area where there's some uncertainty, I think it's on GST revenues, because if you look at the numbers on the central GST, the government's assuming a very large pickup. Now, undoubtedly, one has to make some adjustments here, because it's a new regime. IGST revenues are high this year. They're small next year, and some of that gets allocated to CGST. So, without getting too technical, it's fair to say that for next year's number to hold, one will need to see reasonable buoyancy on the GST front, a much higher compliance than this year. We're still very hopeful that happens, because once the e-way bill goes in, I think that will broaden compliance quite meaningfully. So I would say that, it's a credible consolidation based on expenditure cutting. The only real uncertainty is GST, because if those revenues don't materialize, it'll be hard for the government to slash expenditures in a pre-election year, especially when that growth rate has been quite constrained to start with.
So, Sajjid, you're saying that the net tax revenue numbers, you're not sure about how those will add up. And on the expenditure side, is it realistic to say that they'll be able to curtail expenditure to the extent that they're suggesting they will next year?
I think one has to separate the subsidy component from the other expenditures. This government's track record has been very good on this front, that we haven't seen large expenditure overruns in any of the last 3 or 4 years. I think the one area is going to be subsidies, that the fuel subsidy is budgeted the same as this year. If oil prices remain high, that puts some pressure on fuel subsidies, that puts some pressure on fertilizer subsidies. If the MSP promise is implemented, that pushes up food subsidies a little bit. But then again, I think, there are offsetting and mitigating factors here. Remember, disinvestment next year is targeted at 80,000 crore. This year, the government hopes to get 1 lakh crore. So again, I think if some expenditure components were to overrun, there are other buffers the government may have. I don't think outside subsidies, suddenly the government will wake up 6 months into the year and budget significantly higher expenditures. I think the risk to the deficit stems much more from the revenue side and on the GST side in particular.
Okay. Sajjid, you're comfortable with the medium-term fiscal framework that they've spent out? I mean, they're now targeting 3% only in 2 years from now, and even the recommendations of the NK Singh committee that they've accepted, they seem to have accepted them, in part, right? I mean, they've extended the timelines. Even on the debt to GDP, they're saying till FY25, and I think the committee had said FY23. So have they not been fairly selective in, what they want to accept on this fiscal roadmap?
I think one has to take into account just what the whole transition year has done, because I think if it had not been for the move to GST and the revenue pressures arising from that, I think the government would have stuck to 3.2% this year and stuck to 3% next year. So I think I'm certainly willing to cut the government some slack on that front, that if those timelines get pushed out by 1 or 2 years, I'm not sure that that's going to fundamentally change things. I think it's actually very positive that the government has adopted that debt to GDP anchor, because I think what the bond markets need today, and we saw another bond sell-off today of 15 to 20 basis points, desperately is an anchor. I think what we've lacked in the last couple of years is a fiscal anchor, and so every year people are guessing what that year's deficit is going to be and what the next year is going to be. I think now, I think the key here is GST. That if FY19 is the year where GST revenues stabilize, there's more confidence that the buoyancy is at least as large as the government believes, then I think going forward to consolidate from 3.2 to 3 and stick to 3 appears much more believable. So I think I think it's a good thing that they've adopted those recommendations, because that gives the market a much needed anchor, without which risk premia in the bond market had increased very dramatically over the last 5 or 6 months.
Okay. Sajjid, one more question on the fiscal side, and then, just want to get to some qualitative aspects of the budget. So does this complicate the inflation and the interest rate scenario, both from the RBI perspective, but also the markets? As you pointed out, you had another sell-off in the bond markets today. I think from an inflation perspective, I think the fact that the government's consolidating will help at the margin. I think the biggest kind of uncertainty or risk here will be minimum support prices. Now, there again, there's some uncertainty if the government, how quickly it moves to increase MSPs to be 1.5 times the production cost. If you look at the CACP, there are 2 different kinds of production costs. So which production cost will you use? And if you take a cursory glance at it, many of these MSPs are quite close to 1.5 times. It's only paddy or rice, which is about 38% now. So if you mechanically say that has to go to 50% immediately, given the weight of paddy in the CPI, that could add, somewhere around 70 basis points. But again, I think we're jumping the gun by so quickly. Let's wait and see how the government chooses to implement these MSP increases. Is it staggered out across a year or so? Is it front loaded? What is the quantum? What is the production cost that's assumed? But I think that's the key risk here, apart from the elephant in the room, which is oil prices. And I think one worry has been that if you look at core inflation correctly measured in India, headline adjusted for food and fuel and petrol and diesel and even housing, that core momentum has been 0.5% month on month for the last 4 months. And this cannot be attributed to GST, because this is September, October, November, December, when GST rates were being cut. So that's an annualized momentum of 6%. So I think that's what's going to keep the RBI cautious here, that if core inflation is already tracking an annualized momentum of 6% and there is reflation to food prices from higher MSPs, that will not make for a good combination. Sajjid, what did you make of the broader sort of, they tried to project it as a rural-friendly budget. So apart from this MSP, they had that, health protection scheme, although I have to say that they only allocated, I think, about 2,000 crore to that health protection scheme. Yes. And if you look at the other rural schemes, there isn't much of an increase in Manrega. There isn't much of an increase in the Awas Yojana. So, they projected it as a rural budget. Is it a rural-friendly budget?
I think it's a responsible budget given the fiscal pressures we spoke about. And I think, at least from a macroeconomic stability perspective, I'm very impressed by the expenditure restraint. I think the expectation was in a pre-election year, you'd have expenditures going up easily more than nominal GDP, and people said if nominal GDP is going up 12%, expenditure growth could be 15-16%. The fact that expenditure growth is at 10%, in fact, if you take out the transfers to states, which count as expenditures, it's 9%. And all the consolidation is being achieved by cutting current expenditures. I think that's very admirable. So while there were lots of schemes announced, the allocation has only gone up by 8 or 10% in most cases, which I think is very responsible. The second part is, apart from the MSPs, I think one of the signatures of this government is the focus is very much on infrastructure. So to the extent that these are supply side productivity enhancing investments in the rural economy, over time they certainly will help growth and also become disinflationary. So I took that to be a positive, that while the intent of the speech was to boost the rural economy, the allocation was quite conservative.
Okay, what did you make of the announcement of this health scheme? I mean, something like that, especially if they want to move towards making it universal, would be prohibitively expensive, would it?
Prima facie, yes. I think any universal scheme, I think we have to find a way to means test these schemes. It has to be rolled out in a pragmatic manner where you don't get many leakages. I do think we need much more government spending on education and health. I think we focus so much on physical infrastructure, but if you look at how much the public sector spends here on education and health, we're woefully short of where we need to be at this level of income and this level of development. So I welcome any expenditure or any insurance mechanism for health. But I think you need to balance that with what the cost is going to be. So I would like for it to be well thought out, limited, means tested, and then implemented.
All right, Sajjid, just last two questions. One, anything else that stood out to you that was interesting either in the speech or in the fine print that you want to flag off?
Well, there was one more announcement that in terms of grant, the RBI Act will be changed in terms of a standing deposit facility for the RBI. And I think that gives the RBI a much needed extra instrument to absorb liquidity here. So we'll wait to see what the details are. What will the remunerated rate of interest be? But the fact is, in an era where you have very strong capital flows, and you are intervening to prevent rupee appreciation and injecting rupee liquidity, you now have one more instrument in which to seamlessly absorb that liquidity. So I think that certainly reduces the frictions on liquidity management. The other part that I found a bit interesting was the sense was that because there was not too much space on the budget for public investment, that there will be a lot of off-balance sheet investment that happens through the public sector enterprises. But there again, there's been restraint. If you look at those numbers, they're actually down 11% in absolute terms compared to last year, and therefore as a percent of GDP have also come down. So I think those are the two things that were quite noteworthy. The final one is on SEBI considering whether large corporates need to raise a quarter of their debt in the bond market. But again, the question is, how do you implement it? Will this be calibrated over what time period? Will you then increase the FPI limit for foreigners such that this new supply has incremental sources of demand? So lots of open questions there.
That RBI facility, Sajjid, is the standing deposit facility that they were asking for. It's the same as that?
That's right. That is the standing deposit facility, which was actually a recommendation of the Urjit Patel report back in 2014. It required an amendment to the RBI Act, and the government has indicated it will go ahead with that amendment, which is a very positive.
Okay, got it. Just to sum up then, Sajjid, so should we say that this budget has done nothing to either help or hurt the growth outlook for the economy next year? Can we say the same for inflation?
So I think you're right. I think the first goal that budgets must aspire to is to take the Hippocratic Oath, which is to do no harm. And I think this budget did that. I think in a world where there are some gathering clouds because of where oil prices are and the fact that growth is going up, I think the budget had to give a signal that this is a year of consolidation. So given all the pushes and pulls, pre-election year, more spending, but revenue uncertainty because of GST, higher oil prices, which eats up into fiscal space, nervous and a bond market that's very nervous, I think the budget did the best it could given the constraints it faced. For me, I would watch very closely on two things. One is how do GST revenues evolve next year, especially compliance under the e-way bill. That will be a very early barometer of how likely it is to get to this 3.2% number. And the second, from an inflation perspective, very much is on how the government rolls out the MSP promise.
Thanks a ton, Sajjid. Appreciate this conversation. That's Sajjid Chinoy of JP Morgan giving us some fine print of the budget. Thanks for watching Bloomberg Point.